Stock markets were on today. I suppose that much is a good sign, but not really anything particularly market moving or particularly exciting there today. But of course, last week, an explosive demonstration of trends we've seen on display for the better part of 3 months at this point, and a sign of perhaps a turn brewing on the horizon. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And what we're going to ask ourselves here as we look ahead to what these markets might have in store for us this week is going to be the very important question: how long can markets continue to cheer when we see economic negativity give us more rate cut expectations? Or are we finally getting to a place where it's that negativity itself that becomes the object of interest for investors? Let's begin with what we did in these major assets last week, and a theme is immediately jumping out. So stocks up, S&P up 1.8%, NASDAQ up 3.8%. Not surprisingly, against that backdrop, yields lower across maturities. We can see here the back end of the curve down 2.7% here on the 10-year, the front end down a similar 3.1% at the 2-year. So essentially the entire yield curve across maturities down something on the order of 3%, give or take. Crude oil, again, marching to the beat of its own drum, but gold certainly participating in the stock's higher yields, lower narrative, posting an impressive 2.5% rise. The dollar down, the euro here, the stand-in for the overall direction of the greenback, its most liquid counterpart, of course, up 1.1%. So the story here really screaming of the markets got fuel to price in a more dovish Fed perspective, yields down, gold up, dollar down, stocks up. And the sort of directional trajectory that we've seen evolving here really since mid-April continues to develop. As I say, this is now the better part of 3 months in terms of a narrative, and here we are in the middle of April, as we can see, the cumulative rate cut tally for this year and next is maybe 3 rate cuts. So 76 basis points fully baked in. That's exactly 3, with just a slight sliver of possibility for more, a single basis point, in fact. We can see that this marks the bottom for the S&P 500. So call it the pullback in stocks stops right there. And as we get the market saying, okay, maybe the Fed is reluctant to cut in earnest in 2024, and that's how we got this tally reduced here, these gray bars getting shallower while the yellow ones stay about even-handed. But they will have to cut, and the delay will mean they'll have to cut faster in 2025, that there'll have to be some kind of catch-up, that the Fed is making a mistake, and that they're going to be late. So we can see here that for the better part of these 3 months here, perhaps just a week short, the outlook for this year is about steady. The outlook for next year starts becoming increasingly dovish. And of course, last week was a perfect case in point. Another push lower on this cumulative tally as more rate cuts enter into the calculus for next year. And stocks take another leg higher. They were paused as the outlook was paused in the preceding 2 weeks. They take another leg in the dovish direction, and so stocks get another lift. Now, as unmistakable as this is, the other important piece of evidence here, of course, is that for the first time we got a little bit more of a possibility that there's 2 rate cuts that might appear this year and not just one. So not only did we get a little bit more cumulatively dovish as all of this occurred, we actually also became a little bit more urgent in terms of when the stimulus seems to be on its way. So at this point, the markets are baking in about 40 basis points in rate cuts this year. That's a little bit more dovish than where we were hanging out around 30 this time a week ago. And so as we get into this slightly more dovish setting, there is this sense that we're getting to a place where the outlook is going to struggle to get any more dovish than it already is. And this, of course, is the setting of policy for this month's meeting. This is aggregate in total. So we're pooling the likelihood of one rate cut or one hold at a given meeting. This is for the July 31st meeting. As we can see here, the markets overwhelmingly expecting rates to hold, 93.3% chance that we are unchanged on rates this month. However, September is now overwhelmingly likely to see a cut. And again, these are aggregated probabilities. So if we looked at this broken down into the possibility of a 25 basis point cut versus a 50 basis point cut, you'd see that the internals of this near 81% chance of a cut are skewed in the direction of one cut with a slight possibility for 2. But as we can see, the hold is now the minority opinion. And by the time we get to September, this is effectively baked in. So this, of course, raises an important question. How much more do we really have in this dynamic? Because, of course, if the outlook were to get any more immediate, if it were to get any more dovish near term, well, then we'd be looking at a policy meeting with a cut this very month. And this raises an important question. The markets like to see rate cuts in the future. They like to speculate on money becoming cheaper down the road. When those cuts actually arrive, though, it is because the trend in economic activity and growth has somehow become intolerable for the central bank to enough of a degree to beckon the central bank to act. And so what that means is that, of course, some sort of economic negativity has become so acute that the central bank cannot delay. That is hardly good news, and understandably so, for risk assets. And we appear to be just on that line because, indeed, the meeting after the next one, as we just saw, is almost fully baked now for a cut. And incidentally, the way we got here is indeed with economic deterioration. As we can see, this latest run of dovish readjustment begins, as we just saw, mid-April. That's this right here. We can see that from here onward, U.S. economic data has increasingly underperformed relative to expectations. In fact, last week's ISM data was perhaps a perfect case in point. We can see that for the first time since December of 2022, both the service sector and the manufacturing sector are now in contraction mode. As ever, the ISM survey here is done in PMI form. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And what you find here is that for the first time since December of 2022, which is this blip right here, both manufacturing and the service sector are shrinking. Economic activity is contracting in both. And incidentally, by a wider margin here than here. It is also, as we can see, a shock result. Markets were looking for continued growth at a healthy clip in services and a much slower contraction in manufacturing. The GDP nowcast from the Atlanta Fed, the one that has been relatively accurate recently, there's a number of Fed models, but this is the one that's been fairly good lately. It has suggested a massive downshift in where economic growth is pacing to occur for the upcoming quarter. And so we have a situation here then that seems to say we are in that part of rate cut speculation where action is ever closer, but that means that some sort of economic negativity past the threshold of tolerance for the central bank is also imminent. And it is with this in mind that we consider this week's event risk. First, a set of testimony from Fed Chair Jerome Powell. He's going to appear in Congress this week for his semi-annual reporting to lawmakers. He's going to be in the Senate first, in the House thereafter. The prepared remarks should be about the same for both outings. The Q&A section is where we're going to get perhaps some novelty from one appearance to the next, because there's going to be different questions asked and, of course, different responses to them. On the issue of policy, Powell is probably not going to break much new ground. We're probably going to hear something along the lines of, we like to see that disinflation has resumed in recent months after something of a stall in the beginning of the year. We like to think that we're still on track to cut rates this year, but we need to get more confident that inflation is heading where we want it to go. So we're going to wait for a little bit longer, but we welcome the progress that we've seen, and we're getting close. That much is probably in the market already. Indeed, at 80% for a September rate cut, it seems unlikely that anything is going to get dislodged one way or another. But if that Q&A brings with it a level of discussion of economic growth dynamics that suggests an immediacy in the Fed's view, a sense that they are warming to the idea that easing has to happen sooner because the economy is starting to turn in a way that is raising some red flags for policymakers. And the concern is increasingly less about inflation being sticky and increasingly more about the employment side of the Fed's mandate, then we are getting to a place where perhaps speculating on rate cuts is no longer something that the markets cheer, and the dynamic snaps. We continue to have that conversation as we get updated U.S. inflation data. Expectations are for the headline rate to dip back to 3.1%. That would be near the bottom of their recent range. The headline is, of course, less in focus than is the core, because inflation continues to be made up primarily, as we can see on the chart here, from the service sector, excluding food and energy. That's where things continue to remain stuck, and perhaps a bit worryingly, goods inflation has continued to be increasingly negative, suggesting weaker demand. But at least on the service side, which is the majority of the economy, we still have the Fed's fight in front of it. And so here we're expecting to see 3.4% on the core reading. That would be unchanged from May, but also May was a 3-year low. Now, if U.S. economic data is in fact doing this, if it is underperforming expectations by a broadening margin, then indeed this CPI data might miss the mark as well, which is where things again get interesting. If the miss is significant, first of all, if there is a miss, and if that miss is significant, then a level of urgency on growth becomes telegraphed here. And the conversation stops being about a kind of Goldilocks soft landing and a kind of gradual disinflation that keeps distant rate cuts on the horizon, brings them closer perhaps, makes them perhaps even more expansive, but doesn't sound the alarm on growth, to a conversation about growth hitting the skids near term and the Fed being spurred into action because things are getting uncomfortable on that part of the ledger. And that may very well be the kind of conversation that still is supportive of rate cuts, just not supportive of risk, and amount to trouble for stock markets. And finally, we round out the week with the University of Michigan Consumer Confidence Survey, which has been a very important and very telltale sign of where things are heading. Consumers, of course, the largest component contributing to U.S. economic growth. Over 3/4 of U.S. economic activity is driven by household consumption, private household consumption. And so how confident consumers are is a very, very important input into what this economy is doing, and therefore how soft of a landing we're actually going to get and how much urgency there is around these rate cuts. Now, we can see that since the beginning of 2021, there has been an unmistakable trend here. As inflation expectations in this survey, 1-year inflation expectations were rising, sentiment was cooling. As these things rolled over, as the Fed started to hike rates and fight inflation, and 1-year inflation expectations started to fall, sentiment started to improve. Now, so far this year, there has, of course, been a bit of a pause in disinflation that the Fed kind of famously bemoaned in May and in April. And we saw that as this sort of got stuck and even started to poke up a little bit, sentiment cooled. That kept the trend intact. So now the question will be whether consumers are going to acknowledge that inflation has continued the process of disinflation now for the past 2 months, and looks like we'll continue it again in this latest iteration of the CPI data, and whether that continues to be a source of cheer. Because if, in fact, inflation is accelerating lower because growth concerns are here in earnest, well, then lower prices might not continue to be a source of cheer for consumers. They might say, well, you know what? It's all well and good that prices are falling, but now I'm concerned about employment. Now I'm concerned about the backdrop for why they are coming down. When they were coming down and the economy was relatively strong, that's very clearly positive for the consumer sentiment story. But if now we're in the part of disinflation where it's actual economic cycle pain that's keeping the process moving, Well, then consumers may no longer abide by this dynamic. They may not be quite so happy with inflation cooling. And that would suggest, again, that a legitimate growth concern is now threatening what has been the catalyzing narrative for stocks much of this year. Now, for what it's worth, the market's perceptions of inflation warmed up a little bit in late June, but have since started to come back down. So at least as far as the bond markets are concerned, there is some sort of a dynamic perhaps starting to emerge. And of course, the question will be whether consumers notice. If they do, and this relationship breaks, once again, stocks might be getting into a touchy window here where, because rate cuts have drawn so close, they are no longer a source of optimism. And that is macro money for today. We're going to dig into all of this in more detail as the week progresses. We're here as normal once again, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm on with Victor Jones for The Price of Truth on Wednesdays, back on with Chris for Futures Power Hour Fridays, on with Victor and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow.